So moving on, John, we are about to discuss the implications to employees and workers of the Finance Bill 2024.
Yeah.
And I will just jump straight to it. Last year, we were busy saying how our paychecks are the way they are, courtesy of affordable housing program.
Yeah.
Now we're already used to the way our paychecks already are, but we're seeing some introductions from the Finance Bill. One is scraping off of the affordable housing relief, which is supposed to be capped at 108,000 per year. What does this mean for individuals who won't be receiving that tax benefit anymore?
I mean, maybe just by way of introduction, a relief. What does a relief do to your tax? A relief basically just reduces your taxes, and specifically this provision was very new. It had also just come in, and I think maybe 2-3 months later now we are seeing a proposal to delete it. Of course, that in of itself creates a bit of uncertainty in terms of how our taxation regime works, which is something we've discussed in great length. But maybe in summary, what this means is that now the tax benefit that was previously granted is now being removed.
Again, just still on the affordable housing program, we've scraped off affordable housing relief, but now we've made it deductible as an allowable expense. Now, again, I know to our audience, you're hearing a lot of new words, but let's start with when we say it's now deductible as an allowable expense, particularly to employers. I think employers already understand what an allowable expense is, but to our audience, what do we mean by that?
So specifically maybe let me just begin, first things first. An allowable expense. These are expenses that the income tax allows you to deduct before arriving to your profit, so then you can charge the tax onto your profit. This particular provision gives us two clarities. I mean, the first one is employers and businesses are allowed to make these deductions. And then secondly, which is I think what most of us want to hear about, now from an employee perspective, before calculating your tax liability, this is also an allowable expense. So this is also a welcome proposal.
I was about to say, at least we're seeing a balance when we remove it as a relief, and then we say, okay, fine. If we're putting it as an allowable expense, again, very much welcome from the Finance Bill 2024. Let's come to the developer side, because we've always talked about affordable housing just from the employers and employees who are paying for this tax, but from a developer's perspective, we've scraped off the rebates. So previously, developers enjoyed 15% income tax rebate for at least 100 residential units they had constructed annually. But now we're removing that rebate, which was supposed to incentivize developers to at least get into that space of affordable housing. What do those implications look like now? Do we think we at least reached the threshold we wanted last year when we were saying that we'll build at least 100 residential units? I'm not so sure what the progress is when it comes to the affordable housing levy. And I think maybe I stand guided, as most people who are paying for it, we don't even know if these are houses we want to get or not. Let's talk about that.
I mean, you're right. The Income Tax Act at the moment does provide a 15% rebate for entities that are building affordable houses. So there is a certain criteria provided. One of it being you must be doing about 100 units. Now, the proposal now seeks to remove this rebate. This is also, I think, again, in my view, a curious proposal because I don't think we are there yet in terms
That's
of
what I was asking. What's the progress? Have we done 100 units yet? I mean, I don't know if...
I don't think we have enough units from an affordable housing perspective. I mean, every time I think about this provision, I think what we're trying to do is disincentivize private companies from building affordable housing, and perhaps just making sure that this venture is only left to government. Perhaps in the short term, it would have been interesting to have this provision left in to allow for private sector to also build a bit more of these units. before then the deleting, before this provision is deleted. Yeah.
Anyway, I'm not so sure which developers are in that space of affordable housing, but I would love to have a follow-up on what the progress has looked like so far.
Yeah.
Again, when we're talking about changes in the finance bill for at least employees and workers, we're going to look at particular adjustments when it comes to the employment tax regime. Of course, per diems are a very touchy matter. Yeah. So we're seeing the threshold increase from 2,000 to 5% of the employee's gross monthly income. Perhaps just to briefly explain that. What do we mean by 5% of employees' gross monthly income?
Yeah. Maybe even just to provide even more clarity on this provision, I think one of the things that this finance bill has done is has tried to be slightly more friendly to employees. So maybe just to explain a bit more, the previous provision capped your per diems to 2,000.
2,000 Kenyan shillings.
So if you got more than 2,000 Kenyan shillings, that amount was considered a benefit you're receiving from an employer. So you add it to your employment income before taxing it. So the effect was any per diem you got above 2,000 increases your salary for purposes of taxation. So when you see an increase from, say, 2,000, I think for most people this will be an increase to about 5% of your gross monthly income. It means if you earn
for a lot
more
of
money,
people, if you earn more money, it's on the good side of it.
It could be. It's a good effect for most people.
At least other positives that we're seeing for employees is, of course, your miscellaneous benefits. Again, the threshold has been raised from 36,000 shillings to 48,000. Again, also your meal benefits.
Your meal benefits.
Taxable thresholds for your mean value has been raised from 48,000 to 60,000, which is at least aligning with inflation. So that when we're saying this is how much you're paying for tax, it sort of reflects with the economic times that we're in. I guess, as you've said, this bill seems at least fair to people that work in those
It seems slightly more friendly, at least.
You complain too much about affordable housing. We have found other ways. To minimize the effect or like the tax burden. If you allow me to go through the health insurance contributions. We are seeing we will be contributing to the social health insurance fund, which is now allowed, which is now allowed for tax purposes. Ideally, we will be scraping off NHIF, or rather, we are to phase it out. So perhaps just what are the key amendments when it comes to us now moving to the social health insurance fund?
So we are moving away from NHIF and moving to now what we are calling SHIF. SHIF, of course, the rates under SHIF are higher. We have tier 1 contributions, we have tier 2 contributions. And what this effectively means is more money. Employees are contributing more money in relation to health insurance. When the proposal as is now is to make SHIF contributions allowable deductions, that's a good thing, because what that does is it reduces your taxable income. And effectively what that means is it reduces your tax liability. So it's more like a give and take. You increase the contributions, but then, also give you a slight benefit. So the resultant outcome is maybe not as bad as it would have been had SHIF just kicked in without it being an allowable deduction.
Okay. Again, when it comes to employees, amendments relating to retirement benefits. We are seeing removal of post-retirement medical fund relief. So contributions that were previously allowed deductions capped at 10,000 per month will increase to 60,000 annually. If we can break that down, because when we say that we've increased to 60,000 annually and we were moving from 10,000 a month, what does this mean for post-retirement medical fund relief?
So this is also a good thing. Every time you see there's an increase in terms of your allowable deductions, what it just means is that it means you can deduct more from your taxable income, and resulting into a lower tax liability, at least from a personal tax perspective. So this is a good thing. We are seeing an increase. It initially was capped to about 60,000 annually. Now it's about 10,000, so it's about roughly about 120,000,
which is
on a yearly basis.
Yeah.
Actually, twice. So that's a good thing, because it means, in that sense, if you make this kind of contributions, you are allowed a higher deduction, which ultimately reduces your tax liability. This is also what I would call a welcome proposal.
Very much. Yeah. If you have been making payments, of course, to your post-retirement medical fund. Personally, I haven't. But hopefully in the future, when we decide to get there, this will still be at play. Again, another thing we're seeing is increased deductible thresholds. So we have raised the threshold from 360,000 for full year service and 30,000 per month for past year service. So maybe those two key differences: full year service and past year service.
Again, if you also look at this provision, it's also an increase in effect. And as I'm saying, every time you see an increase in terms of your allowable deductions, that's always a good thing, because that means it reduces your tax liability. And so the thresholds are now increasing to about 360 for full year service, and then 30,000 per month for part year of service. And these are good things, because it ultimately means that your tax liability is ultimately reducing. So this is also another welcome proposal. And as you're seeing, I mean, at least the finance bill, at least for the year 2024, has some provisions which are somewhat friendly to employees
and employers. I think we'll take that as a parting shot. If you are interested, again, in understanding more, I have questions when it comes to NHIF, moving to SHIF, moving to deductions that are being now, we're having the threshold increase. Please feel free to leave a comment, feedback, or a question regarding the same. From our end, it's goodbye.